Hey everybody, Trader Razor here from Conquer Wall Street. It is April the 11th, and I'm thrilled to share my long-term technical and fundamental analysis of the major stock market indexes, stock sectors, Bitcoin, and a few of our trading systems built for busy investors that work during normal trading hours but want to profit from easy-to-follow end-of-day trading strategies. And today I'd like to begin by going over the top fundamental issues that I see affecting the stock markets. Number one on my list is the trade war. The US and China have locked themselves in a really ugly tariff battle that's shaking up the global markets. It started off with a 20% US tariff on China, and then China pushed back hard. And we're now looking at a whopping 125% tariff rate on US imports. This back and forth has created a huge cloud of uncertainty over the markets. And the second thing I'm watching closely is it's my opinion that the markets are priced to perfection. We all know this S&P 500 has been on a wild ride. And despite the recent sell-offs, it's still trading at a PE multiple of 26. That's above the historical average since 1990 when interest rates became so low. The average is about 20. And the historical average full-time going back to 1880 is an average of about 15. If we factor in the potential for future earning cuts, we could be looking at a PE multiple around 20 or possibly even lower if there's more news that comes out affecting the potential for earnings to be cut in the future. It's my opinion that the market might be overvalued given the current economic climate. Then there's concerns about earnings forecasts. Analysts and companies are struggling to provide a reliable full year forecast. And the big question is why? The unpredictability of tariffs is throwing a wrench in the works. This uncertainty led to a significant sell-off after the April 2nd tariff announcement as investors lost confidence in earnings estimates. Then we have recession fears. The market is feeling jittery about a potential recession. Historical data shows significant earnings drops during downturns, and this fear is influencing investor behavior. There's a glimmer of hope with the current tariff pause, but we're not out of the woods yet. Look at the current Kalshi betting odds. Currently, they're favoring 65% probability of a recession this year in 2025. And finally, looking ahead, as we enter into the first quarter earnings reporting period, growth estimates have been significantly lowered. Double-digit earnings growth? I don't think so. It's looking less likely by the day. Okay, let's move on to the technical analysis. And let's begin with the long term, the very long term, the monthly charts of the major indexes. Right here we have the monthly chart of the SPY ETF, which tracks the S&P 500. We've been following this monthly chart a lot because in a normal, healthy bull market, we see on this chart the 50-day and the 200-day moving average. And in a healthy long-term bull market like we've had, we see that the 50-day moving average trends upward, and we notice that price is above the 50-day moving average. And in a healthy market, the market pulls away and it comes back and it touches the 50-day moving average, pulls away, comes back and touches the 50-month moving average, gets extended and overbought, pulls back and touches the 50-month moving average. And we had this big run since November of 2022 where the market ran way up and it was quite extended from its 50-month moving average. And now with this massive correction we've had, we got down really within striking distance of touching that 50-month moving average. And that was probably the healthiest thing that's come out of this with the tariff wars and the pullback that we've seen, is that we got technically from way overextended from where we should be, and we got a pullback. And maybe a lot of people bought that dip when we got down around the 50-month moving average. And we see the same thing if we would go to the QQQs, came back, and we got close to the vicinity of that 50-month moving average. Same thing goes with the Dow Jones Industrial Average. Sorry, let me get rid of that there. Came back, and we just barely missed tagging that 50-month moving average. So that is probably the most bullish technical argument I have. That, and also if we start putting a volume-weighted average price on the chart from the recent COVID lows that we experienced back in the end of 2022, we see that volume-weighted average price lines up nicely with the VWAP. I'm sorry. There we go. Lines up nicely with the VWAP. We had a touch right here in the Dow Jones Industrial Average ETF that came back and touched that VWAP. And if we do the same thing on the SPY, we're going to see it got really close as well. And we're going to see it's really close. It lines up with that 50-month moving average. QQQ, put our VWAP on there. And you're going to see we're right there in that range of where you want to be on a technical pullback for a buying opportunity. And then we have the weekly chart of the SPY, the S&P 500, with the RSI index plotted on the chart. We did have that divergence on the weekly chart, which we talked about as a risk for a market correction. Well, that played out. We got that correction. But now we're having an oversold RSI that is below the 30 level. And historically, when we get a close below 30 on the weekly time frame chart like we have here, we get a significant bounce. We did for the week, we did get a significant bounce. We got this big up candle on the week. The market closed up almost 6% on the week from the prior week. And to prove my point here about these deeply oversold conditions, when we get oversold in the RSI, if we scroll back out here, we'll see the same thing occurred back in 2020. We had a huge pullback in the RSI that was below the 30 level. And we had a big correction where the S&P, the SPY went from about $341 a share and corrected all the way down to a low. What was the low on that? Of $255 per share, about a 30% correction. Very significant in a short period of time. The market got oversold, and then we went on a run from that low all the way up here to a top of about, what was the close for that week? About $475 per share. That was quite a run. Now, I do believe we would need to get some type of news related to tariffs. That would be the catalyst that would cause the market to take off. But from a technical only perspective, we do have an oversold condition. If the right type of news environment comes out where things look more positive heading into the future, Trump's policies start to take off, things with tax cuts and deficit spending getting reduced, we could see this put in a significant bottom that takes off from here and retests these highs. That has yet to be determined. And then I want to talk about the daily chart of the SPY ETF. And I want to compare it specifically to the percent of stocks trading above their 200-day moving average. We see this little oscillator down below. This is an oscillator that demonstrates what percentage of the stocks within the S&P 500 are trading above their 200-day moving average. And currently, we are sitting at an extreme level. This little white line down here represents 30, and it just shows that there are 30% of the stocks within that index are trading below their 200-day moving average. That's quite extreme. And what we can look at historically is this happened again back in the 2023 era, and we see a deeply oversold percent of stocks below the 200-day moving average. And what happens once it crossed back above that 30 level, we saw it shoot up on the oscillator. And what happened to the stock market? You went from a price of about $406 per share on the SPY all the way up to this all-time high of $610 per share. So we have to keep an eye open. Will history repeat itself? Is this that same type of an opportunity where we're going to cross above 30? We're not there yet. We're sitting at 28 right now. on the daily chart. Should we cross above 30, that could be maybe at least a technical catalyst that we have the same type of rally that we saw back in 2023. That being said, though, we are on the cusp of the 50-day moving average crossing below the 200-day moving average, which would be a bearish golden cross. And when we look back historically, when we had that same scenario with the percent of stocks below 200-day moving average, we didn't have a bearish golden cross of those two moving averages. So like I said, this is always, whenever we have these big corrections in the market, it is always usually of a fundamental global news event that affects the future outlook for markets and makes them very uncertain. So there's going to be a fundamental catalyst that'll go along with some of these technical things that could lead to a potential bounce. And finally, I want to go over something on the daily chart here. I know a lot of you have been asking, what am I watching as far as areas of support and resistance to determine where the market might be going in the future? And to that, I like to draw a VWAP on the chart. Right one, I'm going to place right up here at the all-time high on the SPY, which was, what was it, $610 per share. And this tells us all the people that were priced in here where they might be looking to get out if they hadn't gotten out already on this pullback. And we're going to see a volume weighted average price that comes in right about, what is it? Looks like about $552 per share. So from a long-term picture, I'd want to see the SPY trade above this VWAP level and then eventually work its way above the 250-day moving averages. Then you may have had people who bought the dip. So we're going to draw a little bit of a VWAP here on this low that we reached on April 7th. And we see that we are currently, those dip buyers that came in, there is support down here at about $516 per share. So the current closing price today is trading between those two levels. If we narrow it down even further, when we initially got this pullback from the highs, we pulled back, we came down below the 200-day moving average, and we came back and we retested it, and then we collapsed even further. There were a lot of people that on this pullback to the 200-day moving average, they were selling in about this area, and we have a little bit of a pivot that was put in there. So I'm going to draw a VWAP right at that point as well. And what we have is today, those that might have been selling at this retest of the 200-day moving average, the S&P 500 is currently trading above that. But from a big picture standpoint, I'm going to be watching these two levels here, right about $517 per share, and this other VWAP right up here about $551 per share in the short term to see if it can get above there. Should we be able to break above this level, we do still have the 250-day moving averages to contend with moving forward. Now let's talk about the sector performance over the last week. And it was an ugly week for every sector. Even though we had that big up day, for the week, almost every single sector performed negatively, except for the most defensive sector, which is our utility sector, which finished up 2.4% for the week. Technology did make a triumphant attempt to be a leader, but they'll still finish negative almost a 0.5% on the week. This is a short-term determination of where money is flowing. And for a long-term perspective, we always look at our momentum matrix, which is free to our members. And there's two sectors that are really leading. Number 2 on that list is the consumer staples sector. And that isn't even that strong of a performer. We're still right up here about our 250-day moving average and actually a little bit beneath it. And from a big term picture, it has had a nice little bit of a run going back to 2023. We see we had a nice little bull run going in there. But since then, you can see consumer staples really hasn't done much as far as outperformance goes. We have what looks like a double top up here at about the 84 price point, but it is very much range bound, it looks like, in the intermediate term. bouncing around between about $76 per share and a high of $85 per share. It does look like we do slightly have a lower low here and a series of lower highs. And as far as defensive as this sector is, we need to see it break above this little bit of a downtrend line that we have going here and put in a series of higher highs going forward. But this is the second best performing sector, and it may hold up better than the rest of the sectors just because of its defensive its defensive nature, holding consumer staple stocks and food stocks and grocery stocks that usually do well in tough economic times. But the real star of the show is the gold sector, which has been outperforming. Our Momentum Matrix professional subscribers have just gotten into the gold sector again for a short-term trade 2 days ago and done nicely. We're up over 10 points in 2 days. We entered here on April 9th at the open at $282 per share. Congratulations, because since that day, it's done nothing but go straight up, and it's gone up significantly. And as I said to a lot of our members, gold usually goes through these periods of consolidation, and then it breaks out to the upside. We saw that going on here in November. We also see this going on in a period of time here. We're going through this little sideways section, and then it breaks out to the upside. And then if we scroll even further, we see a longer period of consolidation before a breakout to the upside. What I've told my members is I'm really concerned because these periods of consolidation seem to be shortening in the gold sector before the breakouts. And that doesn't bode well for a bull market when gold is being a leader and not a laggard. Currently, we have the 50-day moving average trading above the 200-day moving average, which is bullish for the sector long term. But we are quite extended above our 50-day moving average. We did get a buying opportunity on this pullback, which our members bought into. Now we're looking probably for our system is looking for another pullback into this 50-day moving average to buy and to go long with the expectation that this sector will continue to outperform. If you're not already a subscriber of our premium memberships, you can get access to the Momentum Matrix trading system on our website, conquerwallstreet.com. On to digital assets. Let's start with the fundamentals and the technicals for Bitcoin. And first up, I want to take a look at the Crypto Fear and Greed Index. We're currently sitting at an extreme fear level on Bitcoin, but we haven't seen an extreme fear correction, which is concerning to me. Typically, when we're at extreme fear, we've had a significant earth-shaking move to the downside in Bitcoin and other digital currencies. And we've had Bitcoin up around 100,000, and we've pulled back quite a bit. We're in that 80,000 price point. So a 20% correction to me doesn't seem like extreme fear. And we'll look at the chart. You can decide for yourself. I've seen much, much bigger corrections in Bitcoin. But historically, when we hit these extreme fear levels, it's been a great opportunity to buy and to get long Bitcoin and other digital assets. Will that play out this time? I don't know. But I will share that information with you that it doesn't seem to be reflecting in the price, in my opinion. And then we have our friends at CoinShares. They share the flow of funds by asset classes. They do a study of where the money is flowing into and out of digital currencies. And for the week and the month, we've seen a lot of money coming out of Bitcoin and also out of Ethereum. So it seems like, at least in the short to intermediate term, at least weekly and monthly, there is not a lot of investment interest in these two staples of the digital currency space. And we're even seeing that come out of Solana. The only maybe exception would be XRP in the short term has had some money flowing into XRP. But for the most part, we don't seem to be getting a lot of buying interest in the digital currency space. And that's kind of supported by the Bitcoin long-term holder supply, which measures the hodlers and if they're holding on to their digital currencies or if they're selling them. And the histogram, the green histogram background, we see it usually declines when the price of Bitcoin rises. And the belief is that the long-term holders of Bitcoin are selling it into strength, and then they buy the pullback. And we'll see back here in 2021, the price of Bitcoin was skyrocketing up to about $60,000, and the green histogram was declining into that rally as the long-term holders were unloading their supply. Then when it pulled back to about 35,000, we saw the long-term buyers come back in and buy that dip back up. Well, here we have Bitcoin that was up around 100,000. We saw the holders selling into that rally up to 100,000. And now we're sitting at around 80 some thousand, give or take, depending on the day, in Bitcoin. And we're seeing a little bit of buying interest coming back into the long-term holder supply. We'll have to see if this continues to rally upwards or if this is just a little bit of a blip on this chart and it starts to decline again. And we might expect a more severe pullback in Bitcoin and other digital currencies. And finally, let's take a look at the charts of Bitcoin paired with the US dollar. Currently, we have a weekly chart up on your screen, and Bitcoin looks really great on a weekly time frame. We have, the bullish golden cross of the 50-week moving average above the 200-week moving average. We have a series of higher highs and higher lows on the chart, as we can see. Nice looking uptrend here. We can even draw a little bit of a trend line in here, right about here. That connects nicely going upwards. And we can see that in addition to the support at the 50-week moving average on Bitcoin, we have a little bit of support in this trend line where we could pull back to about 73,000, which would line up with this area of support that we had clustered here going back into 2024. You can come back here and touch this trend line area of support and still be in this nice long-term uptrend on a weekly chart. So Bitcoin, in my opinion, looks great on a weekly chart. There is a nice little order block down here as well in this 60,000 price point, but the way it looks now, I'm not quite sure we'll get there. As long as there is no news shock or an economic collapse, I do think that you're going to see this 50-week hold up or possibly even this trend line in the near to intermediate term. When we flip over to the daily chart of Bitcoin, we see we do have a golden cross, a bearish golden cross where the 50-day moving average has moved below 200-day moving average. But Bitcoin has a history of doing this on the daily chart. We see that right in this zone right here where it does a little bit of sideways action and the 50 crosses below 200 and then immediately crosses back up above it once again. We do look like we have a big order block up here at the highs around 100 to 108,000 where there was a lot of selling going on, and that played out to the downside. But as I've mentioned, I know there's a lot of clickbait that you find on the internet where people are calling this a crash. This really 20% in Bitcoin isn't a crash. A crash looks a lot more like what we saw going back here where Bitcoin went from almost 70,000 all the way down to 16,000. That's a crash. But this little move where we have the long-term uptrend still intact in Bitcoin on a daily chart and a weekly chart doesn't, to me, look like a crash in the price of Bitcoin. I think that's a lot of clickbait that we find on the internet that is just designed to get people's attention. But that's not the case here. Bitcoin, I think, looks pretty decent, barring an economic shock or a stock market collapse. I don't think in the near term we're going to get a significant correction in the price. That's all I have for you this week, folks. As always, stay sharp and prosper. If you have any questions, feel free to reach out to our support team at conquerwallstreet.com.